Today, the economic outlook according to the RBA. Hello again, I'm Martin North from Digital Finance Analytics. We got some more data on the state of the Australian economy today from RBA Deputy Governor Guy Debelle, which built on the recently released statement on monetary policy. There were 4 items which caught my attention. First, the recent rise in money market interest rates in the US, particularly LIBOR. He said that there are a number of explanations for the rise, including a large increase in bill issuance by the US Treasury and the effect of various tax changes on investment decisions by CFOs in some US companies with large cash pools. This rise in LIBOR in the US has been reflected in rises in money market rates in a number of other countries, including here in Australia. This is because the Australian banks raised some of their short-term funding in the US market to fund their Aussie dollar lending. So the rise in price there has led to a similar rise in the cost of short-term funding for the banks here. That is, a rise in what's called BBSW. This increases the wholesale funding costs for the Australian banks, as well as increasing the costs for borrowers whose lending rates are priced off BBSW, which includes many corporates. However, he says the effect to date has not been that large in terms of the overall impact on banks' funding costs, and it's not clear how much of the rise in LIBOR, and hence BBSW, is due to structural changes in money markets and how much is temporary. In fact, in the last couple of weeks, these money market rates have declined noticeably from their peaks. But, in my mind, it shows one of the significant potential risks ahead. Second, the gradual decline in spare capacity is expected to lead to a gradual pickup in wages growth. But the question is, when? He says the experience of other countries with labour markets closer to full capacity than Australia is that wages growth will remain lower than historical experience would suggest. In Australia, 2% seems to have become the focal point for wage outcomes, compared with 3 to 4% in the past. And work done at the bank shows that the shift in the distribution of wage growth to the left and a burgeoning of wage outcomes around 2% over the past 5 years or so. The RBA says that recent data on wages provides some assurance that wages growth has troughed, and the majority of firms surveyed in the bank's liaison program expect wage growth to remain broadly stable over the period ahead. Over the past year, there has been a pickup in firms expecting higher wage growth outcomes, he said, but some of that is the effect of the Fair Work Commissioner's decision to raise award and minimum wages by 3.3%. They suggest that there are pockets where wage pressures are more acute, but while these pockets are increasing gradually, they remain fairly contained at this point. But he concluded that there is a risk that it may take a lower unemployment rate than we currently expect to generate a sustained move higher than the 2% focal point evident in many wage outcomes today. And of course, 2% is roughly the same as inflation. Third, he takes some comfort from the fact that arrears rates on mortgages remain low. This despite Wayne Byers' comment a couple of months back that at these low interest rates defaults should be even lower. Debelle said that even in Western Australia, where there has been a marked rise in unemployment and where house prices have fallen by around 10%, arrears rates have risen to around 1.5%, which is not that high compared with what we've seen in other countries in similar circumstances and earlier episodes in Australia's history. To which I would add yes, but interest rates are currently ultra low. And what happens if rates rise, as we discussed above, or unemployment rises further? And finally, the interest rate reset on interest-only loans will potentially require mortgage payments to rise by nearly 30 or 40% for some borrowers. And there are a number of these loans whose interest-only periods expire this year. It's worth noting, he said, that there were about the same number of loans resetting last year too. The RBA says that there are quite a few mitigants which will allow those borrowers to cope with these increased payment requirements, including the prevalence of offset accounts and the ability to refinance to a principal and interest loan with a lower interest rate. While some borrowers will clearly struggle with this, he says the expectation is that most will be able to handle the adjustment, so that the overall effect on the economy should be small. We are not so sure. This switch away from interest-only loans should see a shift towards a higher share of scheduled principal repayments relative to unscheduled repayments for a time. And we are seeing that in the data. And it also implies faster debt amortization, which may have implications for credit growth. And there is a risk of a further tightening in lending standards in the period ahead. This may have its largest effect on the amount of funds an individual household can borrow, more than the effect on the number of households who are eligible for a loan. This, in turn, means that credit growth may be slower than otherwise for a time, and that, he says, has more an implication for house prices than it does for the outlook for consumption, to which I would add yes, but consumption is being funded by raising deposits and higher debt, hardly sustainable. So in summary, there are still significant risks in the system, and the net effect could drive prices lower as credit tightens. And I see the RBA slowly turning towards the views that we've held for some time. And I guess if there is more of a downturn ahead, they can claim that they warned us despite their settings creating the problem in the first place. If you like what you've seen here today, please like the post and add a comment or a question. I do read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.